Mr. Rajesh Jejurikar and Group CFO, Mr. Amarjyoti Barua. Request our friends in the media joining virtually to please type your questions in the chat box. We will take them after the presentations. To begin, can I request Anish to please share the group update? Thank you.
Good afternoon, everyone. So before I start the presentation, I just want to share that we've had a very strong set of results, which you will see not just in numbers, but also in the steps we've taken to build a strong foundation for growth for the future. Let's start, therefore, with the key messages, as always. Auto and Farm see continued strong execution. And you see this in both the market share as well as the margin numbers. We had promised SUV growth of mid to high teens a year ago. And we have come in a bit ahead of that at 20% growth year over year, in a market that has been a difficult one. Revenue market share is up 210 basis points to 22.5%. And margins for the auto business are up 110 basis points. So all around very, very strong. The farm business similarly has seen tractor volume growth of 12%, again in a tough market. Market share is up 170 basis points. Not easy to do that when you're 40% plus. And margins here are even higher at 210 basis point growth at 18.4% for the year. What you will also see in the results is some write-offs to Category B subsidiaries. We had talked about the categories a few years ago. And as a reminder, Category B were subsidiaries that had a strong, quantifiable strategic benefit, but not quite a profitable path. We have seen the strategic benefit from both Mitsubishi as well as Sampo. And we have now pivoted them to ensure that we have lower losses from them going forward, and hence the write-offs that you would see in this quarter. Both Tech Mahindra and Mahindra Finance are on a good path. Strong execution again. A lot more to do in both cases, but we're very happy with where they've reached so far. Techem has outlined its margin path to 15% in F27. It's on that path at this point. Mahindra Finance has achieved a significant milestone of maintaining GS3 at below 4%. We typically would like to be below 4.5%. We've actually been even better than that at this point. And that transition from a 7 to 8% normal GS3 to a 4.5% or lower number is a difficult one, but the business has done that very well and puts itself on the path of much stronger growth going forward. What we'll talk about also is our scalable growth gems and the foundation that we are building to ensure that they can be profitable and strong businesses for us in future. But all in all, a growth of 20% from a profit standpoint, and we continue to maintain an ROE of 18%. That's what you see here. While revenue is up 14%, profit is up 20%. Profit does exclude the mark-to-market on KG Mobility, which is SsangYong. It really has no impact from a cash standpoint or an operating standpoint. But we had seen profits in the prior year and losses in this year, which essentially offset each other. But in the percentage numbers, you see that impact, and which is the reason why we've taken that out. And 20% profit growth in the current environment is clearly very strong execution, and you'll see that across multiple businesses. Standalone is up 17%, both revenue as well as profits. And with that, we'd like to share a chart on the positioning of our various businesses. And you see this in terms of competitive position on the y-axis and the scale of the business on the x-axis. As you would expect, auto and farm are in the top right, a very strong competitive position, and both scale businesses. Mahindra Finance and TechM have scale, but aren't quite at the level of where we'd like them to be from a competitive standpoint. And there's more work to be done to take them higher on this graph. And then we have our growth gems. And we are now categorizing them into what we call scalable growth gems that have a strong competitive advantage in their industries. And emerging growth gems, which have some competitive advantage, but there's more work to be done to be able to get them higher again. And we are defining valuation targets for them, 2 to 3 billion for scalable growth gems, and getting to 1 billion, which is where we start getting a lot more competitive in that industry for emerging growth gems. Let's look at the performance across businesses. I'll cover auto and farm fairly quickly, as Rajesh is going to cover that in a lot more detail. Key highlights for auto. Number one, SUV player. Very strong electric vehicle order pipeline. Deliveries have begun. And we have very quickly gotten to the number one share from a revenue standpoint already. And disciplined execution with high margins. You see that in the numbers. Farm, new products, a strong geographical focus to drive growth outside India. Margins up 210 basis points, and you see that in the numbers as well. Mahindra Finance has seen a 17% growth in assets under management, despite pivoting to a business which is much less volatile, much more stable. And you see GS3 under the 4% threshold as we outlined earlier. We have deprioritized disbursements last year to make sure we can transition the business to a more stable GS3 level. And you see that in the numbers as well, which is a very strong profit growth at 16% and a very good outcome in terms of that transition. TechM, good deal wins, strong pipeline, bringing in more customers from a consumer and a BFSI standpoint, continuing well on the margin trajectory, and therefore positioning the business very well on the path that it has outlined already. Let's talk a little more about growth gems. Hospitality. 5 years ago, we had 3,700 room keys. Today we have 5,800. And we are moving to a target of 2 to 3 times that, which we'll cover in more detail later as those plans are finalized, which will effectively give it a 5x growth in terms of room keys alone. Logistics, we see revenue as a key metric there, up from 3,500 to 6,100. And they're targeting again close to a 3x growth in the next 5 years. And there also we will come back to you with further details on that as those plans are outlined. With the new CEO, Hemant Sikka, coming in, we see that business on a very strong growth trajectory. Life Spaces, these are the numbers that have been presented by the Life Spaces team publicly. We have grown significantly from 670,000 in pre-sales 5 years ago to 2,800 crores today. And the target there that the business has outlined is actually 9,500 crores, which we're taking the liberty of rounding up to 10,000. And that is really a 14x growth over this decade and positions this business extremely well. More importantly, again, has been shared by the business. Everything that's required in terms of pre-sales in the next 5 years, 70 to 80% of that has already been acquired in terms of land, and it's only execution from here on. There's also a very strong focus on profitability, and which is the reason why we are going ahead with the rights issue, putting more capital into the business and enabling its growth. Sustain up 5x our renewables business. Last mile mobility up greater than 10x, possibly even 15x by the time we are done with it. Up from 14,000 to 78,000 already. So you see a significant growth over the last 5 years. And we are still again trying to target 2 to 3 times that growth over the next 5 years. Trucks and buses we've talked about recently with the SML acquisition. And we feel fairly confident that we can get to a 10 to 12% growth in F31 as we've outlined. So very strong set of numbers in our scalable growth gems, and this is how we are building these businesses to be larger over the next 5 years. And that's what we want the group to do, is have multiple large businesses. And as we go on, we'll share more about other businesses that will start getting to a stronger trajectory as well. This has enabled a consistent delivery in our commitments. We had committed to 18% ROE and 15 to 20% EPS growth on 28th of May 2021 when we reported our F21 numbers. And what you see here is a consistent 18% on ROE, and our EPS growth has actually been 63% year over year since that time. With that, I'm going to invite Rajesh to come up, talk about the auto and farm businesses.
Hi everyone. I'm going to quickly zip through this so that we have time for questions. On the FES side, the key highlight has been the gain in market share. This has been our highest ever Q4 market share. We gained 1.8 share points and also grew quite significantly for the full year ahead of the industry, where in the year we gained 1.7 share points. So a very strong market performance. You can see that here, and this is actually the highest FES market share that we've ever achieved at 43.3%. Farm machinery, we've spoken about quantum growths. We haven't quite got to where we would have wanted to, but crossing 1,000 crores is a critical milestone, and we've accomplished that in the year F25. The farm margins have been very, very strong, and for the full year, the margins in farm have been at 19.7%. A very that for the core tractors, and for the farm standalone has been at 18.4%. To clarify, core tractors is all domestic tractor sales plus tractor exports from India. That's what we call core tractors. This indicates, this chart is a chart we always show to show how we are able to manage a band of margins in spite of what happens to industry volatility. And the strong feature here has been a Q4 tractor margin of 20.8%, which is a very, very strong margin for a Q4 volume. On a consolidated basis, the FES Q4 PBIT grew 25%, and for the full year 14%. This is farm consolidated overall. Just a quick update on the commitments that we had made for 2025 and where we are. The revenue growth is green. We've grown strongly. We've grown significantly on tractor market share, which I just spoke about. We've not achieved the quantum growth we wanted in farm machinery, but we are at 1,000 crores revenue in F25. The one area we haven't done as well as we would have liked to is the international and the exports. This is because around the world we've seen a significant slowdown over the last year and a half on industry size in different markets in which we play. So that's a space we haven't got to where we wanted to. We've done a lot of work on telematic kits in tractors, and that is an area which we are seeing huge traction as we go forward. And of course, we've delivered a very strong ROC of 53.7%. With that, I'll move to auto, where again, breaking it up, doing the SUV segment first. Strong growth in SUV, Anish spoke about that, 20% for the full year, 18% on the quarter, and an increase, a strong increase in market share, clearly indicating that we're doing much better. The industry is seeing stress, but we have been seeing continued momentum. This reflects our journey of growth. The SUV volumes last year in F25 were at 550,000, and revenue market share was at 22.5, which is a very strong gain over the last few years. We spoke about the fact that we got 30,000 odd bookings on day one. We have till now delivered, till a couple of days back, 6,300 vehicles. We started deliveries of vehicles on the 20th of March, and in a period of hence about 40 days, we've delivered 6,300 vehicles to customers. When you convert this into revenue market share for the quarter, so this is the electric vehicles revenue market share, we were actually number one revenue market share of both SUVs and passenger vehicles. And this is just on the numbers that we did. We, as you know, started later in the quarter, and the fact that our average selling price is significantly higher than everyone else makes us a strong number one player by revenue market share. And as we've said earlier, in EVs, our target is not the volume market share like in the SUV space, it is the revenue market share. Moving to LCVs, it's been a very strong performance. We gained 4.8 share points in this quarter and 2.9 share points for the full year. This graph shows how we've grown over time. And while the industry growth has been slow, and you see that on this chart, in the year the industry was -3, we've grown 4%, which is the indication of, as you see that in the market share as well. This is on the back of very good product launches on the Max City side, the introduction of Vero, and channel expansion, especially in the south, which has helped us gain a strong market, a huge market share in south, an area we were not as strong in the smaller pickup segment. The auto margins have gone up, as you can see from this chart. This is the auto standalone margin to 9.5%. Last mile mobility, we continue to grow and continue to be number one in the last quarter. The EV penetration has been growing, and I think in the last quarter we were at close to 25% EV penetration. The auto consolidated, you see the effect of for the quarter, the PBIT grew 10%. For the full year, it was 29%. This includes the performance of Mahindra Electric in the Q4 numbers. A quick update on the auto commitments. You can see lots of greens here. A CAGR of 35%. Number one in SUV revenue market share. Strong growth in LCV market share. The launch of 2 electric SUVs. The international business has been on a good momentum, and we've seen very good gains in market share in South Africa and Australia in particular. Strong scores on brand affinity in the brand track that we do, and a very strong ROC at 45.2%. Just a quick update on auto product portfolio. This is a recap of what we had put out. We had said by 2030, so this is a slide from an earlier deck. 9 ICE SUVs, 7 electric SUVs, and 7 LCVs in total. This is what we had said as 2030. This is what we are putting out as an update now based on what's already been launched. So 7 plus 5 plus 5, and some more which are in the pipeline. So that's based on the products that have been launched since we showed you that slide. There is a new platform that we will talk about. This new platform will have a series of new products that will come, and we look forward to sharing that with you on 15th August. It's a platform vision. It's not the launch of a product. It's a launch and sharing with you what the new platform is and the kind of concepts and products that can come out on that. So that's what we will share with you on 15th August this time. A quick update on the capacity planning. This gives you a roadmap So the critical numbers here are in the short run, that is in the current year, we will add the 3XO and the ROX capacity, which is the 9,000 of each goes to roughly 10,500. So that's the 3,000 extra in F26. We will, for the new platform that we will talk about, be creating additional capacity in Chakan of 120,000 per annum. And we will also start working on a complete new greenfield project to be up by F28. So these are all the actions that we are planning to take on strengthening our capacity. With that, I'll hand over to Amar. Thank you.
Thank you, Rajesh. So just to recap everything that you heard, revenue up 14%, and as you heard from Anish, 20% up in PAT. Reported will show 15%, and that's because we do exclude the impact of KG Mobility when we talk about the 20% growth here. This is an important chart. It shows the contribution of each of the pieces of the business, the segments that we talk about. So you can see auto has been driving a lot of the profit growth. Farm was impacted by the write-offs that Anish mentioned. I'm going to talk a little bit more about that on the fourth quarter charts because I want to give you an idea of the magnitude of write-offs we have taken. That 156 is the impact that we saw in consolidated earnings because of 156 crores because of the write-offs we took. So I'll explain that a little bit more subsequently. The 249 is a very important number. We've been talking about this for a while. The services part of the portfolio has been growing. What this does not show is in our renewables business, depending on when we complete a project and then flip it over to the InvIT, we take gains from any projects that we develop. In F24, we had significant gains from those flips. So excluding that, when you look at the growth of services, is pretty amazing the kind of growth in profitability we are getting from the services portfolio, especially because of the strong performance in Mahindra Finance that Anish talked about, also the improvement in margins in TechM, and the growth gems starting to show the scale that we expect of them. So that indicates the year-over-year 15% that I talked about on a reported basis. Now, this is the standalone results. This will show a 17% increase, excluding the impact of KG Mobility. Of course, once you take out the impact of KG Mobility, it is around 11.5%, 12%. And this is what I really want to spend some time on. We've not called anything out here in the Q4 numbers, and on a like-to-like basis year over year, it's a 20% growth in profitability for the quarter, on a 20% growth in revenue. I just want to highlight for your benefit, this includes what Rajesh talked about, the BEVs which shipped during the quarter, and you know the EVs are not shipping at any margin right now. In fact, the overall EV are going to be at a loss because of the initial costs of setup, etc. So this carries that burden, but still the group was able to deliver a 20% increase in profit year over year. And for many folks who keep a hawk's eye on the standalone results, we have a 22% increase in standalone, but more importantly, we took charges for what Anish talked about, our international subsidiaries and the pivot that we have done in two of them, which is Sampo and MAM, of 654 crores. So that's the magnitude of charge we took in the standalone results, and this is inclusive of that we delivered 22%. If you exclude those which are one-time charges, it's a 55% increase, which is reflective of the strong operating performance that Rajesh talked about in the AFS business in particular, and of course the growth in margins in both TechM and Mahindra Finance. That 654 crores is what you saw on the prior page. On this chart is the 156 at a consolidated, and just so that this is not a very confusing concept, what consolidated results typically carry is investments net of all losses we have taken to date, whereas standalone is showing only the investment. which is why when we take impairments, standalone impairments are usually much larger numbers, but consolidated is much smaller number. So that's basically reflecting the fact that those businesses were underperforming, which is why we are taking some of the steps that we are taking. This is a chart we don't talk about enough, I feel, because this is pretty spectacular. Almost 10,000 crores of cash generated during the year. And it's not come from any one-offs or anything like that. It's pure operating performance. As you can see, almost 21,000 crores of cash generated from operations. So the group has really performed exceedingly well on cash generation, which allows us to take a lot of bold steps in some of the directions that Anish had laid out, all of those growth plans for our gems, as well as any other strategic investments we want to do, including the SML Isuzu acquisition that you're well aware of. That's it, and we'll open it up for questions.
Thank you. Hello. Hello. Can you switch on the mic, please? Hello. Yeah. Thank you, gentlemen. Can I request you to please come on stage? And we would now open up the floor for questions. Yeah, please state your name and the organization you represent, please.
Hello, good afternoon. My name is Yash Jain.
Just 1 second, Yash.
Okay, is this perfect?
Yes.
So I just had a few questions to start with. The first one, as far as the quarterly depreciation this time is concerned, that's gone to about 1,300 crore rupees. The average has been about 950 to 1,000 crore rupees on a quarterly basis. Any particular reason why that has happened? Second thing that I wanted to understand, the inventory situation at this point of time for Thar ROXX and XUV 700. Two more questions, but once you have the answers.
I can take the depreciation, and then I'm sure Rajesh will talk about inventory. So there are two impacts in depreciation. There's, of course, the meal depreciation impact that you will see because you have a full quarter of meal operations. The other impact is every year around the end of the year, we look at all of the programs that we have been working on. These are basically product programs as well as any prototypes, etc., that we are developing. And we look at, do we see future usage of that? And as part of that, we take accelerated depreciation on certain programs. You'll see this every year around the third or fourth quarter. And so there is a one-off impact of that accelerated depreciation. I would quantify it as immaterial for the group around 100-150 crores, but it is a catch-up for the entire year or subsequent years as well that you're just taking on because you're accelerating the depreciation.
On the inventory question, yes, we won't answer product specific, but I'll give you a segment specific response. Auto inventories are well under control. You can easily work that out from the Vahan data, less than 30 days. And tractor inventories are very much in line with our norms.
Okay. Last couple of questions. By when do you expect to turn EBITDA positive or margin accretive on the EV portfolio? Is there an internal understanding on the time? The second one, a few companies have pointed out muted expectations in terms of growth for FY26, but Mahindra & Mahindra is a little different because you have a SUV dominated portfolio where the demand has been very healthy. I'm assuming hence the expectation from FY26 on the growth side could be different from what other players are pointing out. What could be that difference in terms of growth expectations in FY26? Thank you.
So let me take the second one to start with. You're right, it's an SUV dominated portfolio, but the growth is driven by the set of products that the team has developed. and that really positions our portfolio very well. With regard to expectations, I will let Rajesh take that. And with regard to the first part of your question, I'll let Amar take that.
So on EBITDA this quarter, we actually were EBITDA positive on the EV side, and this was without PLI. Of course, the variant mix has been favorable, so we'll have to keep working it, and we'll have to keep driving good performance like in the ICE portfolio to maintain that kind of result. But yes, the team did deliver EBITDA positive in this first quarter. And just a reminder again, Rajesh mentioned it, it was a partial quarter for us on the EV side, so very strong that way.
Yeah, and it will take a few quarters, possibly even a year, year and a half to get to EBIT margin positive on the EV side. And that's part of the investment that is made. And the reason for the incentives also is because that investment had to be made to be able to get there. And it's only when we get to scale in EV will we start seeing greater margins on that front.
Yeah.
Can I request everyone to just keep your questions short? We are in short of time. So, Tushar from NDTV.
Just
there's
one question
yes,
on
respond on expectations.
Yeah, so you are right, we continue to stay positive given our product portfolio, and we will look at mid to high teens for SUV for F26 again. That includes electric. Just to clarify, that's the whole SUV portfolio.
Good afternoon, gentlemen. Tushar from INTV Profit. My first question is to you, Mr. Shah. You are number 2 again as far as monthly sales is concerned. Would you say that is an indicator of a wholesale shift towards how India buys cars, or do we still need small cars to grow car penetration in India? To Mr. Jejurikar, we saw the dealership data come out today, Vahan based, where there's been absolute lack of urban demand, which is negative territory, but the rural sales is up 5%. How is your sales evolving in such a picture, and what would you look for the year to come? And what is happening in the case there is a trade deal? You're seeing great volumes in South Africa as well as Australia. If a trade deal happens, it also works in your favor. Will you look at opening up to the Europe as well as the US market, because both the trade deals are in negotiations there? Mr. Barua, you've mentioned about the EV business is EBITDA positive at this point of time. Can you talk to us about the impact on overall margins of the meal business? There's a doubling of the other income, if you can talk to us a little bit about that.
Okay, so to start with your first question, as I said earlier, it's again the product set that we have out there, which we feel is generating a very high level of demand. And many of them are fairly unique products, the Thar in particular, Scorpio, which we've obviously had for a very long time, and the new electric vehicles coming in. So it's to a large extent driven by the uniqueness, the quality of the product, and the fact that customers are getting a very high quality at a very reasonable price as well. So for us, that's a great place to be right now, and our effort is to continue maintaining that kind of a product portfolio that will give us that growth. And I think that's what's driving consumer demand more than just whether it's small versus larger cars.
So would you say that India has graduated to become a large car market from a small car market?
No, I wouldn't say that. I think in smaller cars also, if there are products that come out at a very high quality, then people will buy those. I think it's a trade-off between what you get for a certain price, and that's really what's driving it, I believe, at this point.
Yeah. Tushar, I'll just build a little bit on this question and then answer your other questions. So, like Anish said, we want to have the right products for customers, and hence we've defined our metric as revenue market share, so that we're not necessarily forcing ourselves to play into a segment where we may not have a right to win. So really everything that we make is what we believe should be highly differentiated and should create great value for customers, and which is why our average selling price is much higher than most of our other players, which is what makes us comfortably revenue number 1 in SUV. So that's really the goalpost, and it stays as that. We haven't seen that much of a slowdown in urban, though there is no doubt that the urban economy at this moment is much tighter. There are many enabling factors in rural economy, as we are seeing in the tractor rebound. We haven't yet started seeing that, as we said in the past, in LCV less than 3.5 tons. So there we have 60-65% of our portfolio is rural, but we haven't really yet seen the industry. Again, you saw in Q4 was a negative growth industry. So hopefully in the year F26, we will see the LCV industry rebound. We're projecting high single-digit growth for LCV less than 3.5 ton industry for F26. But you are right, overall urban, there is urban demand stress at the moment. To your question on trade deals, I don't think that's actively under discussion right now with either Australia, that part of the world, Australia, New Zealand or South Africa. The priority is North America and EU. At this point of time, we have no plans to go to North America. We do have a plan to go to EU with our electric vehicles at some time in the future, as we've shared, but that will be in a calibrated way. Like we've said, we will do right-hand drive EVs first and then do left-hand drive. So we are a while away. And of course, based on what gets negotiated through the EU agreement, it will facilitate us to make in India for the world. Anish, want to add something on the last?
Shakar, you had a question.
Hello, hi. You just talked about the growth.
I'll come back to you, Dashar. I'll answer both those questions. Yeah. Listen. No, that's okay. That's okay. We'll come back at the end.
Yeah. You talked about the growth gems. You talked about the new platform which is coming up on 15th August and again the capacity expansion. So just wanted to understand from your side, what kind of capex or investment are we looking at for the next 3-4 years? Is it part of the guidance which you gave like earlier, or is there any change which has taken place now in terms of expansion?
It is part of the guidance that we've given for auto and farm in particular. For growth gems, it will also depend on opportunities that come up. The SML opportunity that came up was a very good one from our standpoint, and as there are more, we will look at them, but it does not change materially from what we've talked about so far.
Thanks.
Maybe I can just respond to Tushar. So the other income first, because I just want to come back and understand the EBITDA question. Other income is basically driven by all the cash generation that you saw. It's a lot of cash that we have on hand, and it's generating very good returns. We were also invested in high yielding instruments, so that gives you some additional. It will taper down a little bit as we do as we close out the acquisition, as we do some of these rights issues and invest in them. But if the businesses keep generating cash, then of course that will sustain itself, which we expect will happen. And just to be sure I understood your EBITDA question, could you just say? Yeah.
So essentially, you're saying that the meal business is EBITDA positive already. You have the SML Isuzu Act. So you have the meal business becoming EBITDA positive already. From a overall point of view, saying that it will take some time from absolute numbers. So what will be the margin impact of meal going forward plus SML Isuzu coming in? So where do you see the margin profile evolving into for the course of the year?
Sure. So let me address meal, because I think first we need to close SML completely, get the CCI and all that. So we'll address it specifically maybe next in July and give you a full view. On meal, we expect it to be a drag of anywhere from 1 to 1.5 percentage points on overall margins, auto margins initially, because of the high depreciation. I'm talking about at a PBIT level, a high depreciation cost that you will carry on the on that portfolio, as well as the EBITDA being just about close to break even, a little bit positive at this point. So that will be the impact roughly, and as we have explained to you before, we will show that very clearly. The BEV numbers will be reported separately to the analysts so that everybody can see that very clearly and you can see what the impact is.
Sharmistha, I'll take some online questions now. Sharmistha Mukherjee from Economic Times would like to know what will be the capex for FY26.
In line with what we've talked about for our 3-year capex window, we typically do not give capex for a particular year, but we will stay within the 3-year capex that we've outlined already.
Parikshit Luthra from CNBC-TV18 would like to know, how would you describe the customer sentiment as of now, and how has China's restriction on rare earth magnets impacted EV manufacturing?
Yeah, on the customer sentiment, Parikshit, we just spoke a little about that. There is stress in urban areas. Rural is very strong. However, given the demand we have for many of our products, we have been seeing a growth momentum. There's very strong momentum on the electric SUVs as well. We've delivered 6,300 vehicles in the 40-odd day period. So right now, from our product standpoint, we are fine, but there is stress in the urban economy. On the rare minerals point, I think there's an interpretation issue. The way we understand the issue is that it is only based on end use in the guns and weapons space. Also, any rare mineral which is already part of a component that's getting exported from China does not fall under this, because there it's very clear. So while there is a process by which end use certification is being done by individual suppliers where needed, at an overall level we are comfortably placed by way of inventories of any components which are impacted by this for the next 30 to 60 days depending on the component. So there's no immediate production impact, and in the meanwhile suppliers, along with working with the government, are working on the process to get end use certification wherever needed.
Thank you. Sumantra Barua.
Hi, good afternoon, gentlemen. Here, question for Anish and Rajesh. Following on the SML opportunity, are you also exploring or having discussions for having a collaboration similar or maybe of a different kind to strengthen your M&HCV business? Because some of the global players are also looking at tapping the Indian opportunity because of what's happening in the West, and they see more opportunity here. So do you see a win-win opportunity there? Are you exploring actively, or do you plan to? And secondly, on the scalable growth gem of last mile mobility, you have a 3x growth target. So would it be in the existing segments that last mile mobility plays in, or would you explore new opportunities? Because this whole mobility industry is presenting new opportunities in terms of new form factors also. So on your views on that. And lastly, on the clarification on the new platform, Rajesh, would it straddle both EV, ICE, or would it be purely EV?
Yeah, so 3 questions, Sumo, I'll take all of them. The first is on potential opportunities in MHCV. So one thing is very clear, this now, as Anish showed on his chart, is a growth gem we want to take to scale. So we will look for every opportunities to grow. That being said, we are very mindful that market share gain in MHCV segment is not that easy, and hence in the projections that we've given organically, we have said, we are currently at 3, we can go to maybe 5 in a 5-year period. Of course, if there's any opportunity, to collaborate and build greater momentum here, we'll be totally open to that, because now it's in the category of a growth gem which we would want to invest to scale the business. The last mile mobility is a growth of 2 to 3 times by F30, which will include all electric vehicles in last mile mobility. That includes potentially 4-wheelers as well, not just 3-wheelers. In the tonnage category that comes into last mile mobility, it could also include exports and not just domestic market, because we think exports will be a significant growth opportunity as well. So exports will be an area of focus. On the last question on the new platform, let's keep that for 14th, 15th, otherwise then you will say we had nothing new to say on that day, and we are very mindful that we take your time every year on a day which is a holiday, so we do want to keep it meaningful for you on that day.
Thank you, Swaraj. Yes.
Thank you. Swaraj here from Financial Express. You mentioned about more than 30,000 bookings for EVs, of which 6,300 have been delivered so far. Would just like to know how many unserviced bookings you have as of today, and what is the rate at which the EV production will be scaled up? I'm talking about the twins, EV twins specifically.
Yeah. So, Swaraj, firstly, I'm going to avoid getting into specific numbers, but we do have a waiting period at this point of roughly 4 to 5 months based on the open bookings that are there and the new bookings that are coming in. I'm not going to answer the question in a way that you can calculate the bookings. So, I know you are going to mathematically try and add A and B, and I'm not going to answer it that way. What we've learned in the last 40 odd days of going through delivering 6,300 vehicles is the time needed per customer for delivery is significantly different than what happens in the ICE world. Just a delivery explanation process to a customer is minimum 2 to 3 hours. Customers need that type of information. There's also work to be done by way of enabling charging infrastructure to be facilitated, set up, which means working with their societies or their office complexes wherever they want the charger, and all of that needs to be coordinated well, and then there's an installation process to be done at home. So we're seeing that this process is very important to customers to make sure that the experience is very seamless. So as we think about ramping up, this is an added thing over and above the input quality, which of course is a very important parameter because there is a lot of high tech, and so we're going to be very calibrated in the way we ramp up, which is what we've shared earlier as well, that even though we have capacity, we are not operationalizing all of that. But the learning over the last 40 days has been that we also have to be very calibrated in the way we ramp up the delivery at the front end, because that too needs a lot of time, care and attention. And we don't want to move, at a speed at which the customer experience at the time of delivery is compromised. So we are very carefully watching and seeing that our dealerships are ready to spend the 2 to 3 hours that a customer needs per vehicle at the time of delivery, then a follow-up installation process, making sure that the charging infrastructure is adequately set up. So all of these are areas that we need to work on. Overall demand momentum is strong. Feedback from existing customers is really strong. There's a very positive skew to the top end variants in booking, which is what continues from the initial period.
You also spoke about a new capacity coming up overall for PVs, likely FY28 is what you're talking about. Would like to know where the capacity would be coming up, what kind of capacity you're looking to have. Will it be only PV specific, or you're looking to include other types?
Yeah, we haven't decided which state and where we will be in. That's work to be done. It will be a large futuristic plant that we will set up. The cash flow related to that, as Anish said, has been provided in the capex. At this point, we're thinking of it as primarily a PV plant, but we would keep provision maybe for some other elements of our business to come in as we start conceptualizing it and seeing what kind of investment subsidies we get, in different states as we plan for that. Anish, what to add?
Just one last one on your exposure to Blue Smart. Do we have any right now? How many products did we deliver to Blue Smart earlier? And is there a plan to take it back or have it under Mahindra Logistics?
Amar, you have an answer to that? As far as I know, we have long back supplied Veritos and nothing of late. Rajiv Nal, is that correct?
Yeah, that's right.
Yeah. So there's nothing that we've supplied in the recent past. This is what I know. Amar, do you want to add anything?
There is Mahindra Finance has some exposure, but it's not anything major at all. As Rajesh mentioned, on the vehicle side, there isn't much from our fleet which has gone there.
Thank you.
Hi, this is Nilesh. My question is, as you mentioned, there is urban stress even optimism from dealer body has been not very positive this time. So when do you see the market improving, and which segments do you see will have the major impact?
In a lighter vein, the dealer bodies have never given any positive input in the last, ever since I remember. So I don't know if you really want to use that as an indicator of whether demand is good or not in the market. They have a role to play and we have a role to play. So we should all play our respective roles. I think there are several enablers which will start kicking in: government spending, infrastructure spending, all of that, which will lead to urban demand picking up. And the smaller segments should start gaining out of the income tax benefit that will start kicking in from April. So we think that will be an enabler as well. As interest rates come down with time, I think that will be another positive enabler. So I do think that over the next few months, urban sentiment will start picking up. But it's a world where there's a lot of uncertainty at the moment. So multiple things are happening around the world. So we've got to see if there are any uncertainties that come out of that. But overall, I think many macroeconomic factors are positive to enable a positive urban turnaround in the second half. Anish, you want to add?
Yeah, I just want to reflect on the numbers here in terms of revenue growth and PAT growth, where the stress is not really as visible. So yes, there is a fair amount of commentary on urban stress, but one, from our product standpoint, we haven't seen it as much. Even as we look across other businesses, on balance, I would say there is positivity. And the actions that have been taken more recently around liquidity, around reduction of interest rates, I think we'll start seeing a much greater demand that comes in as a result of that. So on balance, I would personally say don't really see too much of urban stress at this point in time. Yes, a little bit of a blip, a little bit of a slowdown, but I think that's something that will come back very quickly.
And just to clarify, since you mentioned a new greenfield facility, so what is the current capacity utilization, and with the scaling up, how much addition would you look at?
Yeah, current capacity utilization on the SUV side is, as you know, almost over 90%, I would think. So we have a high level of capacity utilization. Of course, there will be specific models where it is, fully being utilized, like ROX and 3XO are fully on capacity. Scorpio N is very close to capacity utilization. Bolero is lesser than capacity utilization. So when we give you a total number, it includes all the products in the portfolio. We haven't yet put out a number of how much capacity that will be work in progress, but we are clear that we need a new greenfield, and the multiple new products that we are talking about that will come out by 2030 will need newer capacities anyway.
Okay, I'll take two questions that has come online on farm division. How is M&M planning to electrify its tractors? Do you currently export electric models, and how many years do you think e-tractor adoption in India will start? Also, considering the upcoming TREM 5 norms, do you think electrification in tractors is needed? This is Yukta Mugdal from Autocar Professional.
Yeah. So we are ready with electric tractor by way of product development effort. We think, even based on the fact that we have a presence in US and we've been tracking North America market very closely, none of the electric tractor players have really got into momentum in a market like that, which actually has many segments which could have electric tractor usage, but we've been tracking that closely, and we haven't really seen any movement in that direction. So we're not planning to convert the work that we've done on product development into a ready to launch product. We'll time that to when we think the market is more ready for it. So we're not executing the final stages of readiness there. To the question of will electric solve the problem of TREM 5, no. On TREM 5, there's a very comprehensive government committee that worked on it and has given their recommendations to the ministry. Based on their recommendation, the proposal is to bring in a very limited scale TREM 5 on less than 20, Hemant? Less than 20 horsepower and more than 75 horsepower, which will have very negligible impact by way of cost per tractor.
Yeah, there's one from Rizwan Noor Khan from Kisan India.
20 or 25, just Hemant? 25, yeah, sorry. So less than 25 and 75 horsepower. Thank you.
Yeah. Rizwan Noor Khan from Kisan India would like to know if there are, if you're expecting cheaper tractors from Mahindra Group, because now the prices of tractors and agriculture machinery are increasing, which is becoming difficult for farmers to afford, and also what kind of designs are being planned to make life of farmers easier in the new financial year.
Yeah, we have actually tractors at every price point, and customers have a wide variety of tractors. Just as an added insight, there's a huge used tractor market in the country, and typically a farmer goes to the cycle of maybe buying a used tractor or second-hand tractor first before they come into a new one. That creates very affordable price points as well. It's of course an unorganized industry, and but every dealer has exchange tractors, some of which they refurbish and others they just sell, but that also creates very affordable price points for customers who are price sensitive.
Ketan, you had a question.
Sticking to the farm equipment sector, how is the current financial year looking like from a demand standpoint? Any guidance from your end in terms of what is the kind of growth you are anticipating? And more from a corporate standpoint, you were reviewing your international subsidiaries, and some of the calls in terms of write-offs have been taken. Could you just review the international operation for us as to what were the calls that you took, and how do you see the international footprint of Mahindra evolving from a tractor standpoint?
So domestic tractor industry, we are expecting to be high single digits for F26. Of course, as we always do, we would review this once we see what's actually happening with the monsoon, but that's our going in forecast. Several positive enablers right now that we are seeing. On the international subs, Amar and Anish both touched upon that. There are two companies in which we have taken impairments and write-downs. One has been Sampo in Finland, the other has been Mitsubishi in Japan. In both of these, beyond the write-downs that we've taken, there are actions to reduce costs and reduce losses that we've incurred as a consequence of those as well. So there's an action plan over the course of F26 that will be put in place to improve operations and efficiency.
What is the strategic imperative, and how do you see North America business as well? Because that was facing challenge when it comes to volumes for tractors. And how do you see some of these international subsidiaries playing out in the future?
North America, we continues to see negative growth in the industry. The industry in the year F25 was -13, and that's after almost 3 years of degrowth. So the industry size has come down quite significantly. We expect that should start turning around. One of the factors has been the high interest costs, and that was expected to start correcting. But as you read in the news, there is a point of view between the government and the Fed there on what should happen to interest rates. So we'll wait and watch on how that part of it plays out. But we, with the launch of the OJA series in North America, started gaining significant share. There, the market share that gets reported is the retail market share. And in the less than 20 horsepower category, which is 40% by volume of the less than 110 horsepower segment, which is where we play, the last 4 months our retail share has moved in that segment from 3% to 10%. That was our weakest segment, and which is one of the reasons why we had invested in creating the OJA series. And last 4 months, we've seen that segmental share move from 3 to over 10%.
I have more questions. I'll take it later.
Thank you.
Thanks so much.
Very quick question and exploratory at this point of time, but on the finance side, we've seen in the last 3 months a lot of conglomerates announcing their entry into the insurance market. You have, of course, a business which complements the insurance market very well in terms of that contributing to it itself. Otherwise, also the market's very large. Any plans to sort of enter into that market on the finance side?
We've been looking at that for many years actually. If we find the right way to enter in a manner where it gives us returns excess of market, we will. But it's one where we've looked at it for many years, nothing that's immediate on the horizon right now, but we will continue exploring that.
Thank you so much. Thanks for your time. And if there are any other questions, we are always there to reply back. Thank you. And please join us for lunch in the adjoining room. Thanks. Thank you, everyone. Thanks, gentlemen.